There's no question that we're living through an investment boom surrounding artificial intelligence. Hardly a day goes by without a big tech company unveiling another huge splurge on AI models or semiconductors or data centers, or an AI startup announcing it has raised funds at an even more stratospheric valuation. As we record this podcast, Nvidia, which makes the processors that train and run AI models, is the world's most valuable company with a market capitalization of $3.5 trillion. Share price has almost trebled since the beginning of the year. Investment analysts expect the four companies at the center of the AI arms race, Microsoft, Amazon, Meta Platforms, which owns Facebook and Instagram, and Alphabet, the owner of Google, to collectively make capital expenditures of more than $200 billion next year. This frenzy has market historians reaching for historical parallels. Some point to the internet bubble of the late 1990s when investors pumped large sums into telecom operators and dotcom startups, only for much of that money to evaporate. Others reach much further back, to Britain's railway mania of the 1840s, when rival companies spent vast amounts laying track and operating railways. That also ended badly for investors. Is the excitement about AI comparable to these historical bubbles? That's the question we're going to tackle on The Big View this week. It's what we do at Reuters Breaking Views. We tap our best sources around the world to bring you fresh insights into the biggest stories in global business and finance. I'm your host, Peter Thal-Larsen. Andrew Odlyzko is one of the best qualified people I can think of to tackle this question. I hadn't come across his work until several of my colleagues at Breaking Views started quoting it in the context of writing about AI this year. But since then, I've become fascinated by some of his findings. Andrew is professor in the School of Mathematics at the University of Minnesota, but he's also done extensive research on technology and financial manias. Before moving to Minnesota in 2001, he spent 26 years at Bell Telephone Laboratories, which later became AT&T Labs. That was where he helped debunk a popular myth of the dotcom boom, which was that internet traffic was doubling every 100 days. He's also the author of technical papers on computational complexity, cryptography, probability theory, and many other topics. Andrew Odlyzko, welcome to the Big View podcast.
Thank you very much, Peter. Very glad to be here.
So before we dig into bubbles, past and present, one thing I'd just like to clear up is how does a mathematician become an expert on technology and financial manias?
Well, actually, I could spend hours explaining it in details. There are a lot of serendipity in there, but a very brief version is mathematics led me to cryptography. And I was working at Bell Labs at that time, and cryptography was blossoming in general and was of great relevance for the company, for my employer, and also was intellectually extremely challenging and kind of exciting in those early 1980s. So I got into cryptography, did personal research in cryptography. I am fellow among other organizations. I'm a fellow of the International Association of Cryptologic Research. I have some dozens of papers in cryptography and security. And then in addition to doing personal technical research, and by the way, initially I was just strictly a techie. I had not much kind of a sense for society, economy, or how technology interacted with things. But then I also was promoted. I was in management. So I not only was doing research, I now had to manage and interact with development and marketing organizations about employing technology, cryptologic and related technologies there. And that kind of broadened my horizons. And I ran into all sorts of puzzles. The biggest one was that I and my fellow techies in crypto were inventing what we thought were really breakthrough kind of systems that were, should be solved, that society should be embracing as solutions to pressing problems. And society mostly shrugged its shoulders in various forms. Sometimes it was our management didn't care much for it. in other cases, even when things got deployed, society simply again ignored it. So that kind of broadened my horizons, started thinking about it. And actually, one of the interesting things occurred almost 30 years ago. I actually my employer actually has a patent. I'm one of the inventors on patent on cryptocurrency. From 1990s, it was an earlier generation, not the current kind of cryptocurrencies. So this was a joint invention with a student. I had two summer students, interns, working for me at that time. With one of them, we invented a cryptocurrency, which got patented. The patent has expired and was never deployed, but as usual in these cases. With the other student, we looked at the economics of cryptocurrencies, and we concluded that was never going to amount to very much, that our cryptocurrency, as well as many others. Because we looked at, the economics of digital payments, as well as human factors that are involved in it and such like. And so there's a whole series of encounters of this type, which made me much more aware of the broader context in which technology is used by society. And then, of course, the big kind of internet bubble came along, and I kind of lived through it. I was at Bell Labs, AT&T Labs, and so on during that period. And I was kind of struck how people could ignore all these negative signs, which were kind of clearly pointing out that there was going to be a crash, that all those great expectations were going to be disappointed. But the world just kept going on, in its merry way for a number of years. And so that actually then led me to actually accept a job at University of Minnesota. So I spent slightly more than half of my professional career at Bell Labs and AT&T Labs. And then I came to University of Minnesota, initially in an administrative position, was tasked with setting up and running an interdisciplinary research center devoted to promoting interactions between our academic researchers and industry. And one of the reasons I was actually interested by the job is precisely because it gave me an opportunity and a responsibility to actually explore how it is that basic technical ideas got out into the marketplace. And so, and then of course, and this kind of just took a lot of, quite a few years of my time. Once I completed the job, I didn't want to spend the rest of my time as a kind of manager or administrator. I decided to try to see if I could synthesize what I had learned in my career. And that's what led me to even more intensive study of bubbles. So I kind of felt technology, interaction of technology and society in general is a broad topic. I decided to concentrate on the issue of bubbles, technology bubbles.
And that's how you end up there. Yeah.
Yes.
So that's fascinating. So you've obviously studied the dotcom era, and you've spent a lot of time looking at the railway boom in the UK. I mean, these are very different historical periods, very different technologies. What are the common strands? What do we learn by comparing those periods?
Yes. Why did I get into UK railway manias? Main reason is that the big technology of the 19th century was railways. Okay? That's where kind of it changed people's thinking, it changed what people were doing, changed the economy. That's where most of the investments were going. And so when I was kind of dealing with the internet, lived through the internet bubble and its crash, but it was clear that the internet was continuing to kind of have an effect, again, changing society, trying to think, project what's going to happen to the future. I decided to take a look at previous revolutionary technologies. And the main one, the only one I could think of that was of comparable size, was railways in the 19th century. That's why I kind of concentrated on them. And UK, why UK? So I pretty much have ignored American experience, largely because in America, you had a very heavy involvement of governments. initially maybe states, city, and later federal governments. Whereas in Britain, it really was obviously governments had to be involved in various ways, but it was largely a private enterprise kind of business. And so there seemed to be more of a case of pure market mentalities being involved than market dynamics in there. So that's really what led me in that direction. And now,
And this,
yeah.
Sorry to interrupt, but just for people who are less familiar with this, this was a really huge deal in the context of the British economy at the time. I think at the peak it was something like 7% of British GDP that was being invested every year into these railways. What was driving? And that's probably bigger than what we've seen since. What was driving that?
Well, what was driving it were two things. One was availability of capital. Actually, one of the main things that preoccupied many of the observers, economists, and kind of opinion makers, and so on, and statesmen, was what seemed to be a surfeit of capital. They were really scared about the low interest rates they observed, because where could people put their savings? That certainly was an important element, but the main one was need. Transportation was a bottleneck. The kind of railways, in some sense, were not a totally novel technology of the early 19th century. To some extent, you can trace some of the developments back to the 16th century, kind of in context of coal mines, typically in Germany, also in England and Scotland and such like. And then there was continuing development, and then there were issues such as exhaustion of forest resources, exhaustion of the easily accessible coal seams, and so transportation was becoming more of a bottleneck. Economy was developing, so there was a real pain. Kind of venture capitalists, when you go to them with an idea, they typically say, well, what problem are you solving? If you had a transportation solution, everybody understood what it is that you were trying to solve. Maybe it was an all-the-world idea that you had, but still they were interested in exploring it also.
But then you have then you get this thing where, so people identify this problem, but everybody piles in and everybody says, well, I'm going to build this railway line and I'm going to carry this many passengers at this price, and that's how I'm going to make money. And that's where it begins to go wrong then.
Exactly. When it goes to excess.
Yeah.
Precisely. And of course, you have to again, you get into these dynamics of in technology and interaction with society. Namely, many of the projections are faulty, in some cases obviously faulty. On the other hand, you also have lucky accidents. Railways were for a long time, they were being developed and deployed for short-haul transport of heavy cargo, coal primarily, and so on. What really made the early railways kind of successful and made money and induced the British investors to pour huge sums of money into that infrastructure was rapid transport of passengers. That was not anticipated. There are some hints here and there, some people mention it, but essentially nobody was seriously thinking that rapid transport of passengers over large distances was going to be the driving force. So yes, happy accidents occur, like Amazon. Amazon online bookstore. Okay, well, now most of the money is coming from cloud computing services, which had not been thought of when Amazon was set up. So yes, when you come up with new technologies, you often run into happy accidents.
Yeah. So let's talk about, speaking of Amazon, which obviously kind of got started in the internet boom of the late 1990s, but obviously, and I think at a certain stage, people were questioning its financial viability, and obviously it's gone from strength to strength since then. That period obviously often gets talked about as a dot-com bubble, but in financial investment terms, it was really a telecom bubble, wasn't it? It was telecom companies investing heavily in mobile and broadband networks, and I suppose the same kind of dynamic applied, right? Which is people sort of see an opportunity and then everybody thinks I'm going to be the one that's going to get a piece of that opportunity, and everybody overestimates how much they can sell or what the demand is.
Exactly. And the thing is that with dotcoms, it was kind of a softer barrier that you saw. Yes, there were signs that this was being overdone, that people were over optimistic. Internet time was kind of a myth. Things were not changing as rapidly as people thought. Web then is one of these disasters or dot-com bubble. Well, we have grocery deliveries to people's home nowadays, but it's modest and it's, quarter century later in that case. In the case of the telecom bubble, there you had much harder kind of quantitative signs that things were being overdone. Internet traffic was not growing at the astronomical rates that people were projecting. Wireless was obviously booming, but then again, things like the 3G spectrum auctions in Europe, you could say that was kind of going over the wall because they were expecting to make money off of data services with videos kind of things, and that was clearly not going to happen too. So yes, telecom, so in some sense, the valuations were crazier perhaps in the dot-com space, but there was not that much money being put into those new ventures. It's the telecom where huge sums were sunk, either into fiber, whether it's undersea or land fiber, or into spectrum auctions.
Yeah, I think $1 trillion. I think someone estimated at the time 3% of global GDP at the time, which is quite a lot of money. I mean, what you're saying there about the mobile phone operators bidding up the value of mobile spectrum in Europe reminds me a little bit of what we're seeing at the moment in artificial intelligence, where it feels like you have this arms race and you have these companies, big tech companies, who are all spending lots of money because they feel they have to because everybody else is spending the money. I mean, I realize you haven't written about the whole AI thing in the way that you've written about some of these other things, but when using your experience, when you observe what's going on at the moment, what parallels do you see?
Oh, I think the parallel again, fear of missing out, fear of being felt to be behind the times as perceived by investors. Quite a lot of the telecom companies in the late 1990s, year 2000, were going into that business and promising, sometimes even making big investments, not so much because they really saw a real business case, but if they didn't do it, they will be perceived as not with the times, and they might be taken over by one of these new startups. So the usual kind of dynamics that operate in these kinds of environments, boom times, where you have positive feedback cycles which spur people to go with a crowd. Absolutely. So that's clearly going on with AI. Companies announcing that they are deploying AI just in order to kind of show that they are aware of what's happening.
Yeah, and the other thing you mentioned earlier that sort of strikes me is, in the context of the railway boom, but strikes me as relevant now, is also that idea of surplus capital, right? That I mean, until recently, interest rates were very low, and also these tech companies have vast amounts of cash to deploy.
Yes, right. Well, that's one of the big differences. So again, what happened? Say, if you look at the great railway mania of the 1840s. There wasn't a sudden crash. The problem was that you didn't have this kind of systemic risk. You didn't have a few big financial institutions that could be exposed to runs. It was mostly individual investors. And yes, many of them were ruined in many ways. But it was a case of very long, drawn-out process as people came to the realization that really they had made a big mistake and their money was lost one by one, as opposed to big run on, say, Northern Rock or Silicon Valley Bank or places like that. So that in our case, what happens again with the telecom bubble. One of the reasons that it was such a kind of catastrophic thing is there were a bunch of new companies, often funded by venture capital, often also with some loans and so on, which were putting down, say, fiber or other things, and then they realized that they were falling off a cliff, and there wasn't a cushion underneath to catch them. And what's happening today, most of the investments is being made by companies like Amazon or Microsoft or or Google or kind of Alphabet. They have lots of money. If they have to write it off, well, okay, that will be a big hit, but I mean, it's that their cash cushion will be much lower. The companies that are more exposed are places like companies like Nvidia. What might very well happen is at a certain point, orders for Nvidia might dry up and be catastrophic decline, and either revenues and a much more catastrophic decline in the profits. But again, that's a fairly small sector of the economy. So there's different types of dangers.
Yes, no, that's really interesting. I mean, because one thing that people say often is that bubbles can be economically useful. Yes, most of the investors lose their shirts, but when the dust settles, you still have, in the case of the UK, you have a railway network that, it can still run trains and transport passengers. Or in the case of the sort of telecom boom, you had lots of broadband capacity, which was then very cheap and which people could use to develop the internet and stuff. So what do you make of that argument? And is there an analogy here with the AI boom?
Oh, absolutely. In some sense, so what it does is many of these bubbles, again, it varies. Many of these bubbles do produce things that are useful. Perhaps they are not very efficient. Even if you look at the British rail network that resulted from the big railway mania of the 1840s, and then you look at the big additions that occurred in the 1860s, during the third and less British railway mania, that was quite inefficient. I mean, studies have been done showing that you could have built an equivalently productive network for quite a bit less money. But you got it built.
Yeah.
And in fact, there are many contemporary observers after the crashes who said, well, yes, investors got swindled, but, we got this infrastructure and we're ahead of the rest of the world, in effect. So yes, so there's huge inefficiency. But on the other hand, you do get some build out, and you also get a lot of ideas. There is human cost. I mean, people's lives and careers kind of being derailed almost literally in 19th century, kind of less so nowadays, kind of their careers being damaged, but they kind of are brought to think about what can be done, and then they go on and do other things with that. Society in general, yes, they see that many of these promises were overblown, they're unrealistic. On the other hand, we're brought to think about possibilities. What might happen when you could deploy these new tools, in our case, say the AI tools, that again serve some purposes, good purposes. And then there is another factor too, which I think was, actually, I'll be writing about it fairly soon, is certainly important in Britain in the 19th century. The perception of many of the kind of elite kind of observers, or even decision makers, ministers of the parliament, members of parliament, and so on, it was that with the lack of investment opportunities, if those investors were not offered a chance to invest in this infrastructure, they would do something more foolish with their money. So therefore, let them do it in that case. And I mean, I have this great quote from Walter Bagehot in their case, explaining how Britain got this very nice build out of its railway system by engineers and lawyers conspiring to defraud the investors. So yes.
Yes,
There are ways to find positive element to bubbles.
That does ring some bells. Yes. But so you said early on when you were talking about the sort of working at Bell Labs and or working at AT&T Labs and sort of during the run up in the dotcom bubble, that it was clear it was going to pop. And obviously there are some people who say Alan Greenspan, the chairman of the Fed, famously said you can't spot a bubble until after it's burst. So all you can do as a central bank is clean up afterwards. Sounds like you think there's actually a reasonable argument to be made for being able to identify a bubble when you're in the middle of one. Is that what you would say?
I would say that's true for some bubbles. I don't claim that all bubbles can be identified very clearly. In fact, one of my kind of discoveries was of something which looked like a bubble to many observers, but actually turned to be so very successful. That was the first big British railway mania of the 1830s. Many kind of very knowledgeable and very clever people, like John Stuart Mill, for example, they're very skeptical. They're saying, well, we don't have good grounds for believing that this is going to pay off. It did pay off. There was enough demand that investors, there was a crash in share prices, but investment proceeded. Again, there was a slightly different structure to financial markets. People were kind of committed and they kept pouring money into what for a while looked like a losing venture. And by the end of it, just before the big railway mania starts, they are getting decent payout in that case. So yes, not all bubbles can be identified. One of the cases I studied recently was the British investment mania of the 1860s. In that case, Walter Bagehot was one of several very knowledgeable, well-connected, and very clever and skeptical observers who were trying to see if it was a bubble, and they didn't see it. They were misled by the financial engineering of the time. Now, as I point out in my paper, in fact, Bagehot and the other skeptical observers were not using all the information available. There were very clear quantitative measures which could have shown them that they were off in their estimates of what was happening. But, again, that's the issue. If you look at national intelligence, Hamas attack of a year ago, you look at Pearl Harbor, Nazi attack on Soviet Union, yes, experts study and say there were signs pointing to the impending explosion or attack, but somehow it didn't get processed properly. So there are two issues. One is, are there signs that let you identify it? And second, can you truly identify it in a way that decision makers can be made to realize there is a problem? And then there's yet another problem is, what can you do if you're, say, a central banker or some other authority? Can you actually deflate a bubble properly? In some sense, we're living through a perfect example of this, China. I'm not an expert on China or modern markets in general, but almost everybody who's been looking at China for less than years has been saying it's a bubble that's inflating. It cannot go on. Well, it's all stopped going on. It's sort of deflating. Can they deflate it in a controlled way? That's an experiment in progress. And of course, in China, the central authorities have far more control over the financial sector and the economy as a whole than we can imagine in our societies.
Yeah.
So yes, I'm not claiming that all bubbles can be identified, but I claim that some bubbles definitely can, and some of them have been identified. Some of them, and in retrospect, we can say, yes, there were very clear signs they were going to pop.
Well, and actually, that sort of brings us back to the kind of current AI frenzy, because, you're right. I mean, on the one hand, as you described, we've got these big tech companies which are sitting on huge amounts of cash, which are spending lots of money. Um, and you've got sort of people bidding up the value of companies like Nvidia. But if you're a regulator or a central banker, it's not obvious that there's much you can do to save these people from themselves, right? I mean, it's sort of, it's kind of, it's just sort of one of those things.
And in that case, I would say in the current situation, there is probably not much of an argument, even if you could convince yourself that the AI bubble is excessive, too much hype in there, is a good argument for intervening. And it's really the people who can afford kind of the money who are spending it, the shareholders of Microsoft and Alphabet and Meta and so on. And if they lose a few $100 billion, well, okay, so it'll be somewhat poorer, and the valuations of these companies will crash a bit.
Yeah.
Society as a whole will not be affected too much.
Yeah. I just want to come back just before we close, just to one thing that you talked about right at the beginning, which was about cryptography and cryptocurrencies. We're talking about happy accidents. I mean, obviously, one of the things that has helped to sort of propel the AI boom is that companies had spent a lot of money, invested a lot of money in data centers and processors to mine Bitcoin. And so, and those processes are now being repurposed to train large language models. So there's sort of an interesting sense in which this feeds upon itself. But what, just looking, observing again at what's been happening in cryptocurrencies recently, how do you think about that fitting into your work?
Oh, I mean, cryptocurrencies, again, I'm writing a paper on it because I feel it's a perfect example of trends in our society as it's becoming more complicated, and we're kind of losing contact with reality. We have more information available, but individually we know less and less of what's really going on. And so we're going off into this almost fantasy world in many situations, the post-truth world. Some of the things we see, many of the things we see in politics are actually reflected, or maybe even were foreshadowed by what we saw in areas such as cryptocurrencies. When you just look at what they were supposed to do. I mean, the advantages of things like blockchain, this is all quite old. I mean, the Bitcoin is now 16 years old. On the other hand, there was nothing really new. No new technical ingredients went into Bitcoin. Actually, there were precursors of Bitcoin 10 years earlier or even more. Just simply didn't take off. It's a matter of, I think, our society becoming more subject to the groupthink and kind of crowd psychology and so on, running into after certain things and ignoring other other evidence that points in other directions. So I'm not saying that that cryptocurrencies are going to crash. Just because you look at payment systems that humanity has used over the thousands of years, I mean, sometimes they're fairly arbitrary. And in fact, the cryptocurrency scene is a perfect example of some of these trends. I mean, Bitcoin, many people who are experts in the field have pointed out, is not all that efficient. There are technically better cryptocurrencies, but it's still the dominant one. So again, it's an issue of network effects, switching costs, and crowd psychology that really dominates what happens in there. So yes, technology is very important, but I feel that we're kind of moving into an era where we have almost a surfeit of technologies, and society based on influencers and other factors goes in one direction or another. Kind of very hard to predict which way the herd is going to go.
Well, that's fascinating. And when you finish that paper, we're very interested to read it, and maybe we can talk about that a bit more. We're sitting here as Bitcoin is enjoying another surge upwards following the election of Donald Trump. So it'll be interesting maybe to come back and talk about that in the future. But for now, Andrew, I just want to say thank you for that fascinating discussion and for taking your time. And and hope we can keep talking about. I'm sure we'll have plenty of other bubbles to talk about in the future.
I certainly expect so. Right. Pleasure talking to you. Okay.
Thanks so much.
Right. Take care.
Thanks for tuning in. This podcast was produced by Oliver Tasic in London. You can listen to a new episode of The Big View every Tuesday on the Reuters app or your favorite platform. And don't forget to tune into our sister podcast, Viewsroom, every Thursday, as well as the other great podcasts from the Reuters team. If you like what you heard, please follow The Big View and let us know what you thought. And check out our views on the biggest stories in business and finance every day at breakingviews.com and Reuters.com.